This video does not constitute financial advice. I'm not a financial advisor, so it's for entertainment purposes only, and you should undertake your own research or consult with a professional financial advisor before making any investment decisions. Today, I'm going to take a look at some basic technical analysis and a couple of formations that you've probably heard of called the cup and handle formations. First off, let's discuss technical analysis as an approach to help you make investment decisions. Technical analysis is not an exact science, it's more an art form, but it's based on the behaviour of crowds, and therefore patterns that emerge are much the same as any patterns that you might see in nature. A great example of this is the Pareto principle. You can apply the 80-20 rule to natural phenomena such as 20% of bees harvesting 80% of a hive's pollen, or in human behaviour, like 80% of crimes being committed by 20% of criminals, and in economics, such as 80% of wealth being owned by 20% of the population. In your portfolio, you'll probably find that 20% of your investments and trades will give you 80% of your returns. Some technical analysis aims to use more sophisticated natural patterns, such as Fibonacci numbers, to predict chart moves. Again, the Fibonacci ratio, or the golden ratio, appears everywhere in nature, and technical analysts can use these natural patterns occurring in human behaviour as reflected in the charts. While it might sometimes sound far-fetched, it's anything but. Humans are naturally predisposed to follow the crowd. If a stock price hits a certain level, a group of humans will demonstrate a higher probability to buy or sell at certain levels based on the previous price action. I would say that using technical analysis to predict chart moves is an effective approach, but, and it's a big but, the way the chart is behaving is largely an interpretation. While one analyst might see one pattern emerging, another analyst might see another pattern. One of the worst patterns for misinterpretation in my experience is the head and shoulders top or bottom. Many times I've seen technical analysts predict a stock move based on a loose-looking head and shoulders pattern, only to be completely wrong and see the chart go in a completely different direction. More reliable patterns tend to be bull flags, which are short downtrends defined by investors taking some profits as the stock price has risen too quickly, or triangle patterns, which show the price coiling to make larger breakout moves defined by a new trend direction. So, let's take a look at the cup and handle pattern and why it occurs. At first, a stock price will rise aggressively into a blow-off top, where it spikes up to a new high, and then there are not enough buyers to sustain the market. What follows is a waterfall sell-off that can be very painful for those who got in at the top. Eventually, the energy of the sell-off begins to slow, forming the curve shape, and investors lose interest in the stock and look elsewhere for returns. This results in a period of volume consolidation, where the stock moves sideways for a period of time. Eventually, interest in the stock begins to return, sometimes after many years or decades, and the price begins to rise again. And then a price breakout will occur, and the energy will return to the market, pushing the price back up to its previous high. This high, however, holds very strong resistance, meaning that there will be sellers ready to sell at or slightly above the previous high. Generally, this selling is quite aggressive, but it does not result in a cascade sell-off like the previous high. The price will pull back and consolidate in a large bull flag formation, and then break out, making a powerful move back to the previous high, forming the handle. Another retest of the high occurs, only this time there is more confidence that a cascade fall is less likely to occur. Furthermore, if the cup and handle formation is big, as in a number of years old, there's the inflation factor to consider. There will be more investors and more money available to push the price up and beyond its previous high. When the price finally breaks through the previous resistance, there's no further psychological resistance holding it back. It will continue to rise aggressively, resulting in large gains, sometimes many multiples of the previous high. This is why people find cup and handle formations so compelling. Once they break out, they generally signal enormous gains. Let's take a look at the cup and handle formation in gold. In the first pattern, you can see how the aggressive rise to a new high plays out. The top is in and buyers get exhausted, selling into somewhat of a cascade fall. After a period of time, the price starts to rise again, just briefly touching the previous all-time high, but then it pulls back into a bull flag pattern. If we overlay the cup and handle, you can clearly see how it fits with the multiple touch points on the curve. It's a perfect representation of a cup and handle pattern. But what happens next? If I now zoom out, you can see the price action. With no resistance levels, the price is free to rise and nobody really knows where the top is. Boom! The price gets smashed out of the park into another blow-off top. Quite a spectacular move, I'm sure you'll agree. To put this into context, let's look at the dates and the prices of this move in gold. This was the mid-1970s move in gold that occurred when inflation had taken off and the energy crisis was unfolding. The cup and handle played out between 1975 and 1978 before breaking out of its handle formation and rising to a price from around $175 an ounce up to $880 an ounce in 1980. That's a five-fold move, or 500% in less than 2 years, or more precisely, from the breakout of the handle formation in July 1978 to the top in January 1980 was a mere 15 months. So where are we now? In the context of today's prices, you can see the previous cup and handle breakout from the 1970s, and it looks fairly insignificant compared to prices today. The 70s were followed by a long consolidation throughout the 80s and 90s, and you could argue that there is another cup and handle pattern here. But it doesn't map very well, and to be honest, it looks like more of a plate, so I didn't bother drawing it. However, the same breakout rules apply. You can see where the price slightly exceeds the previous 1980 all-time high in 2008. It then consolidates into somewhat of a flag pattern, and then breaks out to an all-time high in 2011. The new cup and handle that interests me more, though, is the one that we're in now. I've overlaid the cup, and while it doesn't map perfectly, remember technical analysis is more of an art than a science, it does show a repeating pattern. A period of consolidation followed by another rush up, followed by a consolidation flag. Let's take a closer look. What I've done here is zoomed in and drawn a slightly shallower curve at the bottom, but used some lines to show the sides of the cup. I would say that it's a better representation of a cup now, and it's an almost perfect formation, with the handle forming as a bull flag to the right hand side. This is an incredibly compelling pattern, given where we are in the markets right now. Gold now needs to break through 1800 and potentially we're off to the races. Indeed, if this is a similar move to what we saw in the 1970s, a 500% move from the breakout, then you can imagine the price action. From here, we're looking at a likely breakout in gold to occur in the next couple of months. Just to help your imagination a little, I've completed the chart to see what it might look like if we experience a similar 500% move over 18 months or so. Looks quite unbelievable, doesn't it? But I bet that's what they said in 1978. I've droned on long enough for this evening, and I haven't even mentioned silver. Let's save that for next time.